Joining us now is Bridgewater Associates co-CIO and one of the Barron's 100 most influential women in U.S. finance, 4 years running, Karen Carniel-Tambor. Nice to see you in person.
Great to be here in person.
Especially since getting the new job at Bridgewater. So, regional banks, some of these banks, PacWest, Western Alliance, are having sharp declines again. We thought that First Republic deal would be an end to the panic. Is that not true?
Well, I think that when you have tightening that's as rapid as what we've seen, I mean, the tightening we're coming out of is the fastest tightening we've seen in decades. You're going to get reverberations of that. And it's almost like the market expected there'd be no reverberations, no consequences to tightening more than we have in decades. And the most natural consequence to get is a credit tightening. And so you don't know necessarily which banks will tighten credit to what degree, and not everyone knew exactly which banks had which exposures. But the fact that a credit tightening needed to take hold, that is the goal of the tightening. You're trying to slow the economy and bring things back into equilibrium, as you're saying. And what we're seeing ahead of us is months where that credit tightening is now going to reverberate and do its work, slowing the economy.
So how has it influenced your view of recession this year?
It hasn't much, because I was expecting that tightening would flow through. I didn't know exactly where, how, what pace. But my view is that the economy needs to slow. I don't know if the tightening the Fed has done is enough to slow the economy sufficiently to really bring inflation back down to what its target is. And so I really see one of two paths. Either that tightening keeps reverberating through and does slow the economy. There's a real probability of that. And we go into a much deeper recession than is currently priced in. Markets are expecting, kind of barely a blip, mediocre growth, but not much. And in that case, the Fed can really ease into those circumstances, although it still has to be cautious in doing so. Or the economy doesn't slow that much, more like what is priced into markets. And then inflation is a lot stickier than we'd like, and the Fed's going to have to tighten more in order to actually engineer a slowdown.
Either scenario sounds not great for risk assets.
That's right. I think it's one of the most dangerous and bad times for risk assets that we've seen in
stocks
decades. And not great for bonds either, because you're really in a situation where either the Fed will need to tighten more to slow the economy, or inflation can get more entrenched. And so one of the amazing things about bond markets is that no matter how high inflation's been, expectations for the long term are that the Fed always gets what it wants. And don't worry, inflation's going back to normal. If that starts getting questioned, if more investors say, wait a minute, the Fed's being easier into these circumstances, maybe inflation won't just go back to normal. You're going to need structurally higher interest rates.
Karen, really quickly, I am curious, some of those who are more constructive on asset prices would argue that the tightening was already in place even prior to Silicon Valley Bank, and that this was just an acceleration of that. And even if you look at, models that look at credit contraction, most of them are saying maybe 50 basis points out of GDP on the full year. Is that Pollyanna?
I think that's totally right. This was in place well before Silicon Valley Bank failed. This was in place. We didn't know exactly how it would play out, but we knew that credit contraction was going to make its way through, the tightening was going to make its way through. We don't know exactly how much it will slow the economy. When you listen to those estimates, if that's all it is, if that's all the credit contraction does, well, that just means that the Fed is going to have to do another round of tightening sooner or later in order to get the economy to slow sufficiently, deal with the inflation problem. And when you look at where inflation is, and inflation is going to fall somewhat from where it is, but even if inflation goes from 5 to, say, 3%, and you still have very low unemployment rate, at what point will the Fed ever tighten to control inflation, if not when the economy is pretty good, when unemployment rate is still low?